Director and Senior Analyst at Bernstein, along with Vikram, who is the Vice President and Co-Group Head at Corporate Rating at ICRA. So Vikram, let me come to you first. As Anisha was putting in perspective what has actually happened, it appears a bit structural. Now, whenever this kind of a big disruption happens, there are two sides of it. One, the ones which get impacted negatively, the other one who are the beneficiaries of it. How do you see both the sides? Which are the category of companies, one which will be impacted negatively and the one which will be beneficiaries?
Thanks for having me today. So on the pricing, definitely the solar PV modules and cells have seen a significant reduction over the past 12 to 15 months. So the beneficiaries would definitely be the solar power developers. So if you see in 2022, the bid tariffs in the solar power market were in the range of 2.2 to 2.4 rupees per unit. At that time, the module prices were at all-time highs, about 27, 28 cents per peak watt, and even cell prices were at about 15, 16 cents. From there, the module prices have now come down, the international market to about 12, 13 cents, and cell prices have come down to 5, 6 cents. So the viability for these developers who have won the projects at 2.2, 2.4 is looking much better now compared to what it was, say, 1 year back. Similarly, on the bids that have happened in 2023, the tariffs are in the range of 2.5 to 2.7. Here again, the developers are benefiting from this sharp reduction in the module and cell prices for the last 12 months. On the flip side, obviously, for the solar OEMs, domestic solar OEMs, there is increased pricing pressure from the imports coming in from China. While there is a protection available in the form of the basic customs duty imposed on imports, despite that, the pricing pressure has increased. The other point that one needs to take note of is that government had notified this approved list of models and manufacturers, wherein all developers who are bidding for these utility scale projects are required to source module from the manufacturers in this list. And this list only has domestic solar OEMs. There is no foreign manufacturer on this list. This notification has been put under suspension for this fiscal, that is from April 1st, 2023 to March 31st, 2024. So now this created obviously uncertainty for the domestic solar OEMs because there is a dumping of imports from Chinese players with this increased pricing pressure. The expectation from the OEMs is that this measure will be reinstated from April 1st, 2024, which will kind of give a protection for the domestic OEMs against any cheaper imports. Because under this notification, you have to compulsorily procure all the modules from the domestic OEMs in this list, which will create that demand. That's what the uncertainty is. If that policy clarity appears post April 1st, obviously, I think the plans of domestic OEMs should come back on track. Now, of course, apart from that, the other aspect is the demand. Currently, I think in India, we have installed, the peak installation was about 13 gigawatt, which was in FY23. This year, the expectation is it should cross 15, 16 gigawatt in terms of the annual solar installations. Against that, the current solar module manufacturing capacity, what the industry says is over 50 gigawatt. So there is a gap between the demand and supply. So the annual installations have to go up. Obviously, the OEMs also have to tap the export market. So there is obviously two things. One is the protection from imports. The other one is obviously the gap between demand and supply and how would the export demand shape up going forward. All these factors will determine how the solar OEMs will fare going forward. But definitely, this is a positive for the solar power developers who have bid out projects for the past 2 to 3 years.
Solar power developers will definitely get to benefit because their cost of borrowing is pretty much fixed. Their overall, tariffs have been set, and of course, the prices have come down. But let me get Nikhil also into the conversation. Nikhil, help us set the industry demand-supply context, as Vikram was also pointing out. Why are the companies rolling back their solar capex, and what's your take? Is it transient or is it a bit more structural?
So on the solar PV market, what has happened is module prices have crashed globally from over 25 cents beginning of last calendar year to about almost 10 cents per watt peak now. The reason this has happened and why you see potential investors pulling back or holding on to new capacity is because there's been an oversupply globally of solar modules, especially the key component, which is polysilicon. So if you look at polysilicon manufacturing capacity, that is expected to reach almost 1100 gigawatts per year globally by end of this calendar, whereas the global demand for solar modules is about 400 gigawatts. So hence there's a massive supply glut which is happening on solar modules, and hence the prices are crashing globally. This has been the biggest shift which has happened. The second thing which has happened, even on the Indian front, on the same line, there's a lot of supplies coming up. Many players are looking to add new module manufacturing capacities. aided either by the PLI scheme or even otherwise. And with that, even the domestic market, especially on module manufacturing, we see a possibility that after a few years, there'll be a supply glut, which is there.
Sure. But what's your take then, Vikram, about this in terms of the companies which get impacted? Could you list out some names in terms of which could be the companies where capex might come under the scanner a bit?
Company-specific plans. But overall, as I mentioned, currently the module manufacturing capacity in India is over 50 gigawatt. And the demand from domestic installations is only about 15, 16, which is the current year. Maybe it will go up further to about 20 gigawatt in the next couple of years. So there is a gap between supply and demand. So unless the installations, the solar power installations grow up in a multifold way over the next few years, there is going to be the demand supply glut that will create uncertainty on demand front for the OEMs who are having these plans to scale up their manufacturing capacities. And secondly, the other aspect is that exports have seen a significant increase over the past 2 years. Because of the effective ban on Chinese imports by US, the Indian OEMs have benefited. So a lot of players have been able to export their modules to US over the past 2 years. So essentially, the plans will depend on what is the kind of protection that is available from imports, either in the form of ALMM or BCD. And then what is the kind of growth that we're going to see in the domestic solar power installations. And thirdly, the export demand. All these three factors will determine the capex plans for the various domestic OEMs going forward. Because already we are in a surplus capacity scenario, but obviously we are only at the last stage of manufacturing in the module. We don't have sufficient capacities in cell, wafers, polysilicon. Definitely there is scope for capex by these players, but on the module side, there is overcapacity in the market right now. But we should see plans by players to backward integrate into cell manufacturing, wafer manufacturing, and also polysilicon, as announced by some of these leading players, also through the PLI scheme.
Right. Okay, point taken. Last question to you, Nikhil, before I wrap up the conversation. You tell us the impact analysis. Who will benefit? Who stands to lose?
It's not a transient issue. We think it's a more medium-term issue and likely to continue. In terms of gainers and losers due to this, see, the biggest beneficiaries would be the developers, solar developers. And the second list of beneficiaries would be the EPC contractors, as you rightly mentioned. So companies with the largest renewable pipeline in India are three. All three we cover. One is NTPC, second is Adani Green, and third is Renew Power. These three companies have a massive renewable pipeline, which they have to install. And with module prices crashing, which is the biggest input cost for them, their returns on those projects should improve. The second set of beneficiaries are EPC contractors. For example, where we have L&T in our coverage. L&T, for example, does a lot of solar EPC work in the Middle East as well, and typically on a turnkey basis. Hence, crashing of module prices should aid their margins going forward. So these, I would say, are the two key beneficiaries. And among the ones negatively impacted are the entities setting up largely module manufacturing plants. Not many listed names, but some listed names have a few of those, have some exposure to that space. But they are the ones who could potentially be negatively impacted.
Okay, on that note, we're completely out of time. Nikhil as well as Vikram, thanks so much for making time and speaking with us. So that's the latest on what's happening in the solar power industry. With that, it's a